A Liberian-flagged oil tanker carrying 2 million barrels of crude, enough to power the entire United Kingdom for 3 full days, was making its way through the tightest shipping corridor on the planet when an Iranian anti-ship missile tore into its hull amidships. The blast sent flames roaring 200 feet into the night sky. Within moments, the captain broadcast a distress signal. The crew evacuated, and 20% of the world's oil supply, the roughly 21 million barrels per day that flow through this 21-mile-wide choke point, ground to a halt, not because Iran physically sealed the strait, because Iran demonstrated beyond any doubt that it can obliterate any vessel passing through it at will, and the United States Navy cannot prevent it. Over the next several minutes, I'm going to walk you through exactly which weapon system Iran deployed, why this tanker strike stands apart from every prior escalation in the region, and what oil at $150 per barrel, or even $200, actually means for your daily life, starting right now. But before we get there, you need to understand what was truly lost in the Strait of Hormuz. It wasn't just a vessel. It was the assumption that global energy infrastructure operates under some kind of protection. That assumption kept oil prices in a stable range. That assumption kept insurance underwriters willing to cover tanker voyages. That assumption kept shipping executives willing to authorize transits. Iran erased it with a single missile, and the consequences have been cascading ever since. Here is what actually happened. The Strait of Hormuz has experienced ongoing geopolitical and economic disruption since February 28, 2026, following joint military strikes by the United States and Israel on Iran, which included the killing of Iran's supreme leader Ali Khamenei. In response, Iran launched retaliatory missile and drone attacks on U.S. military bases, Israeli territory, and Gulf states, while its Islamic Revolutionary Guard Corps issued warnings prohibiting vessel passage through the strait, leading to an effective halt in shipping traffic. The targeted vessel on April 1st was a very large crude carrier registered in Liberia, operated by a Greek shipping firm, loaded with Saudi crude destined for refineries in South Korea. The ship was transiting the designated shipping corridor, the traffic separation scheme, approximately 8 nautical miles off the Iranian coastline. At 3:47 a.m., the vessel's radar operators picked up an inbound contact. 14 seconds later, an Iranian anti-ship cruise missile, likely a Noor or Qadir variant based on its flight profile, struck the starboard side just aft of the superstructure. The warhead, carrying roughly 165 kilograms of high explosive, detonated on impact. The blast punched through the hull, ruptured fuel storage, and ignited the crude cargo. Fire swept rapidly across the deck. All 23 crew members made it to lifeboats and were later recovered by a naval patrol. The tanker was still burning at the time of this recording. Now let me explain why the specific weapon matters. The Noor is an Iranian reverse-engineered variant of the Chinese C-802 anti-ship cruise missile. It has an operational range of approximately 120 kilometers. It travels at subsonic velocity, around 900 km/h, hugging the water's surface to stay beneath radar coverage. Its active radar seeker autonomously locates and tracks vessels in the final phase of flight. Most critically, Iran has deployed hundreds of these missiles along the Hormuz coastline on mobile truck-mounted launchers capable of firing and relocating within minutes. You cannot destroy what you cannot locate. You cannot locate what appears to be an ordinary truck. And Iran has spent 2 decades refining this shoot-and-move doctrine specifically for this moment. The United States Navy has Fifth Fleet assets in the region, destroyers equipped with Aegis combat systems, cruisers carrying advanced air defense batteries, and a carrier strike group within 200 miles. None of it stopped this missile. The geometry is simply not in America's favor. The strait is 21 miles across at its narrowest. Iranian batteries line the northern coast. Tankers follow predictable, well-charted routes. The flight time from a coastal launcher to a target is under 3 minutes. A vessel has perhaps 90 seconds from detection to impact. That is not enough time to maneuver a 300,000-ton tanker out of the kill zone. It is barely enough time to sound the alarm. American warships can intercept some incoming missiles, but not all of them. And Iran does not need to hit every tanker. Iran only needs to hit one to achieve its strategic objective, which is precisely what it did. Iran has essentially imposed an economic blockade against Middle Eastern oil producers by closing the Strait of Hormuz, the vital artery connecting Gulf Arab producers' oil exports to global markets. As Kuwait Petroleum CEO Sheikh Nawaf al-Sabah put it, this is an attack not only against the Gulf, but it is an attack that is holding the world's economy hostage. The actual target of this strike was not a single tanker. The target was every insurance underwriter, every shipping executive, every tanker captain, and every oil trader who now has to decide whether the Strait of Hormuz is a viable trade route or an active kill zone. Here is what unfolded in the first 6 hours. Roughly 20% of the world's oil and natural gas normally passes through the strait, and the disruptions caused Brent crude prices to jump 10 to 13% in early trading, with analysts warning they could reach $100 per barrel or higher if disruptions persist. European natural gas futures surged on fears that Middle Eastern LNG exports would be cut off. The biggest shock was to natural gas prices, which rose by almost 50% in Europe and nearly 40% in Asia as Qatar Energy, a major supplier, halted the production of liquefied natural gas after its LNG facilities were attacked. Asian equity markets opened sharply in the red. Every index tied directly to energy imports fell hard at the opening bell. But the most severe damage is not in the price spike itself. The real wound is in the insurance market. Protection and indemnity insurance is critical for shipping. War risk coverage was removed by March 5th, making the economic risk too high for ship owners to use the strait. Without insurance, vessels don't sail, regardless of what the cargo is worth. Most major ship owners and operators suspended operations through the Strait of Hormuz. Maersk, the Danish shipping and logistics giant, suspended all future transits through the strait until further notice. MSC, the second largest carrier, followed within hours. If the two dominant players in global shipping refuse to transit the strait, the smaller operators certainly will not. The warnings and subsequent attacks on vessels caused a sharp decline in maritime transit, with tanker traffic dropping first by approximately 70% and over 150 ships anchoring outside the strait to avoid risks. Soon afterwards, traffic dropped to about zero. This disruption affected about 20% of the world's daily oil supply and significant volumes of liquefied natural gas, prompting major shipping firms to suspend operations in the area. Now, here is the number that should be alarming every government on the planet. You just can't take 8 to 10 million barrels a day of oil and 20 or so percent of the LNG market off the world stage without having some significant repercussions, ConocoPhillips CEO Ryan Lance said. Saudi Arabia has the East-West pipeline capable of moving around 5 million barrels per day from its eastern fields to Red Sea ports, bypassing the strait. The UAE's Abu Dhabi crude oil pipeline can handle roughly 1.5 million barrels per day to the Gulf of Oman. That gives you 6.5 million barrels per day in bypass capacity, which means approximately 14.5 million barrels per day, around 15% of global supply, has no alternative route to market if the strait remains impassable. What happens when 15% of the world's oil vanishes from the market overnight? Prices don't climb gradually, they spike vertically. In conversations with more than 3 dozen oil and gas traders, executives, brokers, shippers, and advisors, one message was repeated over and over: the world still hasn't grasped the severity of the situation. Many drew parallels with the 1970s oil shock, warning a prolonged closure of the Strait of Hormuz would threaten an even bigger crisis. The closure of the strait, through which about 1/5 of the world's oil supplies transit, along with production slowdowns in some Gulf countries, has raised concerns of further disruptions. Concerns around the duration of the war, which began on February 28th and has shown no sign of abating, are also adding to uncertainty, sending oil prices soaring. The IRGC has made its position clear. Iran's IRGC said it would not allow a liter of oil through the Strait of Hormuz, stating that any vessel linked to the United States, Israel, or their allies will be considered a legitimate target. The IRGC's statement ended with a stark warning: you will not be able to artificially lower the price of oil. Expect oil at $200 per barrel. Global strategic petroleum reserves, the emergency stockpiles governments hold for exactly this scenario, are now being deployed. The International Energy Agency announced that its 32 member countries had unanimously agreed to release 400 million barrels of oil from their emergency reserves to try to lower prices. And yet, IEA Executive Director Fatih Birol was clear. The most important thing for a return to stable flows of oil and gas is the resumption of transit through the Strait of Hormuz. Dozens of countries agreed to release 400 million barrels of oil, but it didn't bring down prices. The market understands that reserves are finite. Traders are bidding prices up in anticipation of those stockpiles running dry. The price curve is steepening. Front-month contracts trade at a massive premium to future deliveries, a condition known as backwardation that signals acute physical shortage. What does sustained high oil prices mean in practical terms? Europe is likely to face surging prices to secure cargoes and is at risk of diesel shortages in the coming weeks. If the strait stays closed, the world will have to significantly reduce its oil and gas consumption, but not before prices spike to a level that forces consumers and businesses to fly, drive, and spend much less. Shell CEO Wael Sawan warned that fuel shortages will ripple around the world, beginning with jet fuel, followed by diesel, and finally gasoline. Petrochemical feedstocks, the raw inputs for plastics, fertilizers, and pharmaceuticals, would see cascading price increases working through every manufactured good. It's not just fuel. Petroleum is used to make plastics, which are used in just about everything. The broader economic damage extends well beyond energy. The price shock and shortage of fertilizer during the spring planting season could reduce the planting and yields of corn in the U.S., the main feedstock for U.S. beef, poultry, and dairy, and potentially increase global food prices into 2027. Urea prices have already increased by 50% since the start of the war as of late March 2026. Parts of Africa have already faced supply disruptions, and governments are implementing measures to reduce consumption. A closure of the Strait of Hormuz that removes close to 20% of global oil supplies from the market during Q2 2026 is expected to raise the average WTI price of oil to $98 per barrel and lower global real GDP growth by an annualized 2.9 percentage points. And that is the conservative scenario. Oxford Economics modeled a scenario in which global oil prices average $140 a barrel for 2 months, what they characterize as a breaking point for the world economy. That, they find, would be enough to push the Eurozone, the UK, and Japan into economic contraction and create an economic standstill in the US central banks now face an impossible dilemma. Raise interest rates to contain inflation driven by surging energy costs and crash the economy, or cut rates to support growth and let inflation run hotter. Every path leads somewhere painful. The Federal Reserve, the European Central Bank, the Bank of Japan, all of them are boxed in, and Tehran is fully aware of it. The political fallout is already well underway. President Trump announced his intent to seize control of the Strait of Hormuz on March 9th, and later warned Iran not to lay mines in the waterway. On March 19th, the United States Armed Forces began a military campaign to open the strait. On March 22nd, Trump threatened to obliterate Iranian power plants if they didn't completely open the strait within 48 hours. And yet, as of today, the market is rapidly pricing in the impact of a prolonged war and closure of the Strait of Hormuz. Trump did not present a U.S. plan to open the strait during his national address, the vital sea route that Iran has effectively shut down with its attacks on tankers. Oil executives and analysts warn that the Strait of Hormuz needs to be reopened by mid-April, or oil supply disruptions will get significantly worse. Geopolitical strategist Marko Papic estimates that the world has lost 4.5 to 5 million barrels per day of oil due to the war, amounting to about 5% of global supply. But that number will double by mid-April, becoming the largest loss of crude supply. Prices will be supported even after the war ends by new demand for stockpiling, heightened insurance and freight costs associated with the Strait of Hormuz, and a broader geopolitical risk premium in the market, analysts noted. As one Rystad energy analyst put it, moving forward, There will be no going back to the pre-war status quo. Now here is the part that the mainstream media will not clearly explain. The United States cannot reopen the strait through military force alone. The US Navy will struggle to protect the shipping lanes from the Persian Gulf through the Strait of Hormuz and out into the Gulf of Oman. The Iranians have hundreds of miles of sea lanes they can attack, and the US would need to protect all of them. Iran is not attempting to close the strait with a traditional naval blockade. It is making the strait economically uninhabitable by proving that any ship transiting it can be struck and destroyed at will. You don't defeat that with destroyers. You can only defeat it by eliminating every mobile launcher along the coast. Share this video, because what I'm about to tell you is the part that should keep every world leader staring at the ceiling at night. This tanker strike was not the escalation, it was the proof of concept. Iran proved it can weaponize global energy markets without firing a single shot at American military forces. The missile hit a tanker. The real target was the world economy, and the weapon worked exactly as designed. As one veteran oil analyst who started his career at the International Energy Agency in 1990 put it, "This is the worst I've seen. We've seen nothing like this, possibly since 1973. We've never seen the Strait of Hormuz shut." We're in a de facto situation where the Iranians are controlling the strait. The situation is extremely grave. US government officials and Wall Street analysts are starting to consider the prospect that oil prices might surge to an unprecedented $200 a barrel. If that level holds for 6 months, the global economy contracts sharply. If it holds for a year, what follows isn't a recession, it's a depression, and Iran controls the valve, not OPEC, not the Federal Reserve. Iran, because Iran controls the Strait of Hormuz, and the Strait of Hormuz controls 20% of the world's oil. The world changed. The assumption that energy infrastructure is protected, that shipping lanes are safe, that economic warfare operates within limits, all of it is gone. What comes next is not a question of if oil hits $150 or $200, it is a question of how long it stays there and whether the global economy survives the answer. Thanks for watching. What do you think happens next? Does this de-escalate before the damage becomes irreversible? Or are we already past the point of no return? Let me know in the comments and make sure you're following, because this story is only just beginning.